My parents told me buying a house was the smartest financial decision I could make. My teachers said it. Financial advisors said it. Every responsible adult I respected said the same thing. Get a stable job, save your money, buy a house as soon as you can afford one. So I did exactly that, and it nearly destroyed my financial future. Not because the house was bad, not because I got scammed or made an obvious mistake, because I fell into a trap so well disguised that millions of people walk into it every single year thinking they're doing something brilliant. The house payment trap. I'm going to show you how this trap works, how it captures people who are doing everything right according to conventional wisdom, how it silently drains wealth-building potential for decades, while everyone congratulates you on your responsible decision. This information would have saved me years of financial stagnation. Maybe it will save you. The advice your parents gave you made sense in their economy. Get a job, save money, buy a house, build equity, retire comfortably. This path worked for previous generations because the math was different. Houses cost 3 or 4 times annual income. Wages grew consistently. A single earner could support a family and buy property within a few years of starting work. That economy no longer exists. Houses now cost 8, 10, sometimes 15 times annual income in many areas. Wages have stagnated relative to asset prices for decades. 2 earners often struggle to afford what 1 earner bought easily a generation ago. The advice stayed the same while the underlying math changed completely. Following the traditional path that worked for your parents often makes your future self poorer, not richer. This is the first thing you need to understand. Conventional financial wisdom is not neutral. It's not universal truth that applies across all economic conditions. It's advice that emerged from specific circumstances that may no longer exist. Blindly following this advice without understanding the current math is how people end up working their entire lives and retiring with almost nothing. They did what they were told. They followed the rules just didn't work anymore. The house payment trap is one of the most damaging examples of outdated advice, persisting into conditions where it no longer makes sense. Let me show you how simply saving money fails to build wealth. Most people understand that they should save, spend less than you earn, put the difference in the bank. This seems like the foundation of financial responsibility. But saving alone, without strategic deployment of those savings, guarantees you become poorer over time. Inflation destroys the purchasing power of money sitting in bank accounts. If inflation runs 3% and your savings account pays 1%, you're losing 2% of your wealth annually. Not gaining, losing. Over 10 years, that slow loss accumulates significantly. The money you carefully saved buys meaningfully less than when you earned it. You feel like you did the right thing. The math says you didn't. Saving is necessary but not sufficient. The money must work. It must grow faster than inflation erodes it. It must multiply through investment rather than merely being preserved through storage. This distinction between saving and investing is fundamental. Saving is holding. Investing is growing. Holding money in an inflationary environment is guaranteed slow loss. Growing money through properly allocated investments is how wealth actually builds. Most people conflate these two activities. They think saving is wealth building. It's not. Saving is wealth preservation at best, and in inflationary periods it's not even that. So why do people save instead of invest? Because saving feels safe. Because investing feels risky. Because the bank account shows a stable number while investments fluctuate. This perception of safety is the illusion. The stable number in your bank account represents declining purchasing power. The fluctuating investment account represents long-term growth despite short-term volatility, which is actually safer over 20 or 30 years. The guaranteed slow loss or the historically reliable long-term growth. But before you can invest meaningfully, you need capital to invest. This requires income beyond your expenses. And this is where the first strategic decision matters. The path to financial freedom begins with increasing income, not just reducing spending. You can only cut expenses so far. There's a floor below which life becomes miserable, but income has no ceiling. The same hour of work can produce vastly different income depending on what you do, how you do it, and who you do it with. Most people focus almost exclusively on expense reduction. Clip coupons, cancel subscriptions, pack lunches. These actions help marginally. They don't transform. What transforms is developing income streams beyond your primary job, converting skills, knowledge, or interests into revenue, creating value that people will pay for. Everyone has something. Knowledge others lack, skills others need, access others want, experience others value. The difference between people who build substantial income and people who don't is often just whether they've identified what they have and found who needs it. I knew someone with deep expertise in a narrow technical field, expert-level knowledge accumulated over years. She never thought to monetize it beyond her salary until she started consulting on weekends. That consulting eventually exceeded her salary. The knowledge existed all along. The income didn't materialize until she chose to create it. The technologies available now make income creation easier than ever in human history. Digital platforms let you reach customers globally. AI tools let you produce content at scale. Online marketplaces let you sell services without geographic limitation. Previous generations needed capital, infrastructure, and local market access to generate income beyond employment. You need a laptop and willingness to act. Knowledge arbitrage is particularly powerful. Learn skills that are emerging before most people recognize their value. Offer those skills before markets become crowded. The early movers in any new field command premium rates because supply hasn't caught up to demand. What skills are emerging now that most people don't yet understand? What knowledge would be valuable but hasn't yet become common? Finding these gaps and filling them is one of the fastest paths to income growth. But income growth alone isn't enough, because how much you earn matters less than what you do with it. And this brings us to understanding investment. Investment approaches exist on a spectrum from passive to speculative. Passive investing requires minimal attention and expertise. Index funds that track broad market performance. Diversified portfolios designed by others. Set it and forget it approaches where money grows approximately in line with the overall economy. This approach suits most people because it produces reasonable returns without demanding time, knowledge, or emotional control that most people lack. The person who invests consistently in index funds over decades will build substantial wealth even without any investment skill whatsoever. Active investing requires attention and expertise, selecting individual stocks, timing market entry and exit, making judgment calls about specific companies or sectors. This approach can produce returns above passive investing, but often produces returns below it because active investors frequently make errors. Overconfidence, emotional reactions, poor timing. Active investing can work, but usually requires genuine skill that most people overestimate in themselves. Speculative investing is high risk, high potential return. Startups that might become massively valuable or completely worthless. Cryptocurrency that could multiply or collapse. Ventures where total loss is possible and large gains are possible. This approach requires even more skill and emotional control, the ability to lose money without panic, the knowledge to evaluate genuinely risky opportunities, the discipline to size positions appropriately so that losses don't devastate. Most people should primarily invest passively with perhaps small allocations to active or speculative approaches as their knowledge grows. This isn't exciting, it's effective. The mistake is jumping straight to speculation without the foundation of passive investing already established. People want excitement. They want quick returns. They see others apparently making fortunes and want the same. But the others they're seeing represent survivorship bias. The people who got lucky are visible. The people who lost everything are invisible. For every crypto millionaire story, there are thousands of crypto loss stories that never get told. Build the passive foundation first. Let that compound. Add active or speculative elements only with money you can afford to lose entirely without affecting your financial foundation. Now we need to discuss time, because time is the most powerful force in wealth creation and the most frequently wasted resource. Starting early produces dramatically different outcomes than starting late. This isn't motivation, it's mathematics. Money invested at 8% average return doubles roughly every 9 years. If you start at 25, that money doubles 5 times before 65. If you start at 40, it doubles less than 3 times. The same dollar invested early becomes 8 times larger than the same dollar invested later. Not from better skill, from more time for compounding to work. Young people have an advantage they rarely appreciate. Mistakes are recoverable when you're young. Bad investments can be offset by decades of earning ahead. Lessons learned early prevent larger mistakes later. Older people face a different reality. Time is shorter. Mistakes are costlier. The compounding window has shrunk. This doesn't mean it's too late if you're starting later. It means the strategies must adjust. Perhaps more aggressive saving rates. perhaps different asset allocation, perhaps different timeline expectations. But for young people reading this, understand what you have. Time, the most valuable financial asset that cannot be purchased. Use it now. Start now. Even small amounts invested early become substantial amounts later through nothing more than time passing. Every year of delay costs more than you can calculate until you reach the end and see what could have been. But most people don't invest at all, even when they understand they should. And this is where emotional and psychological barriers enter the picture. Money triggers emotions that prevent rational behavior. Fear keeps people from investing because losing money feels worse than gaining money feels good. The potential pain of loss outweighs the potential pleasure of gain even when the probabilities favor gain. Complexity overwhelms people into paralysis. Investment options seem endless and confusing. Rather than make a potentially wrong choice, people make no choice. They tell themselves they'll figure it out later. Later never arrives. Avoidance is common. People don't want to know how bad their financial situation is. They don't track spending. They don't calculate net worth. Ignorance provides temporary comfort that costs long-term opportunity. Social pressure distorts decisions. People buy things to impress others rather than things that serve their actual life. They maintain lifestyles they can't afford because changing would require admitting the lifestyle was never sustainable. Short-term desires defeat long-term intentions. The thing you want now feels more real than the future you can only imagine. Immediate gratification wins against abstract future benefit. Breaking these patterns requires developing a clear vision of your future self. Who do you want to be in 10 years, 20 years? What does that person's life look like? What financial foundation supports that life? When this future vision becomes vivid and emotionally compelling, it competes with immediate desires. You're not just denying yourself the purchase, you're choosing your future self over the temporary want. Without this vision, every financial decision becomes willpower against desire. Willpower loses eventually. With this vision, decisions become choices between two real things. What you want now and who you want to become. That's a fairer fight. Now let me explain the specific trap that captures so many people who think they're making the smartest financial decision. Real estate in general can build wealth. Property can appreciate. Rental income can provide cash flow. Leverage can multiply returns when used wisely. But the specific way most people buy houses, particularly their primary residence, often prevents wealth building rather than enabling it. The house payment trap works like this. You earn income. You save some of that income for a down payment. This takes years because down payments are substantial and saving is slow. During those years, house prices rise, often faster than your savings grow. You're running, but the target is moving away from you. Eventually, you accumulate enough for a down payment on what you can afford. You buy the house. Everyone congratulates you. You feel successful. You've done the responsible adult thing. Now the trap activates. Your mortgage payment consumes a large percentage of your income. In expensive markets, 40 or 50% is common. Even in affordable markets, 30% is typical. Property taxes add more, insurance adds more, maintenance adds more, repairs that surprise you add more. The total cost of housing often consumes half or more of household income when everything's included. Half of everything you earn goes toward one asset, one illiquid asset, one asset that generates no income while you live in it. Meanwhile, what's left after housing costs must cover everything else. Food, transportation, healthcare, children, entertainment, saving, investing. After housing takes its share and life takes its share, investment often gets whatever remains, which is frequently nothing or nearly nothing. This is the trap. Your wealth-building capacity is consumed by your house payment. The money that should be compounding in diversified investments is instead paying interest to a bank and covering the costs of property ownership. Your house might appreciate, but appreciation of your primary residence doesn't help you unless you sell and move somewhere cheaper or downsize. While you live there, the appreciation is theoretical, unrealized, inaccessible. Meanwhile, the investments you couldn't make because the money went to housing would have been growing, compounding, building actual accessible wealth. I ran these numbers for my own situation and the result was devastating. The additional money I put into housing costs above what adequate housing would have cost, invested instead in index funds over the same period, would have been worth substantially more than the equity I built in the house. Substantially more. I didn't make a bad housing decision by conventional standards. I made exactly the decision everyone tells you to make, and it cost me compared to the alternative nobody told me about. This doesn't mean never buy a house. It means understand what you're trading when you do. You're trading investment capacity for housing stability. You're trading liquidity for equity in property. You're trading diversification for concentration in a single asset. Sometimes these trades make sense, sometimes they don't. The problem is making them without understanding their trades at all. The worst version of this trap is buying as much house as you can possibly afford. Banks will approve mortgages that consume dangerous percentages of income. Just because you can borrow that much doesn't mean you should. The bank's risk tolerance is not the same as your optimal financial strategy. Buying at the edge of affordability means zero margin for investment, zero margin for error, zero margin for opportunity. Your entire financial life becomes maintaining the house while building nothing else. I've watched colleagues do this. Maximum house, minimum remaining. They look successful, they own impressive properties, and they have almost no investments, no flexibility, no cushion. If something goes wrong, job loss, health issue, economic downturn, they're immediately in crisis. The house that was supposed to provide security becomes the source of catastrophe because the payments can't be sustained through disruption. So what's the alternative? How do you avoid the trap while still having a place to live? The strategy is controlling housing costs to preserve investment capacity. This might mean renting longer than conventional wisdom suggests. Renting isn't throwing money away if the alternative is throwing even more money at house while building no other wealth. Renting can be the mathematically superior choice in many markets when you compare total housing costs to investment returns. This might mean buying less house than you can afford, taking the mortgage approval and cutting it substantially, living in adequate housing rather than maximum housing, using the difference to invest. This might mean buying in a lower cost area, geographic arbitrage. Remote work possibilities that didn't exist a generation ago make living somewhere affordable, while earning income calibrated to expensive markets possible for many people. This might mean house hacking, buying a property with rental capacity, living in one unit while tenants pay most or all of the mortgage, converting housing expense into housing neutral, or even housing positive. Each of these approaches preserves what the trap destroys: monthly cash flow available for investment. That preserved cash flow, invested consistently over decades, builds wealth that a house payment never can. The house sits there being a house. The investments compound. The difference after 20 or 30 years is enormous. Let me connect this back to strategic wealth building overall, because housing is just one piece. True financial security comes from diversification across multiple asset types. Stocks provide growth and liquidity. Real estate can provide cash flow and appreciation if structured correctly. Businesses you own or invest in can provide income and equity. Precious metals provide stability during economic uncertainty. Cryptocurrency provides exposure to emerging technology if you understand the risk. Concentration in any single asset type creates vulnerability. The person whose entire wealth is home equity faces disaster if real estate markets decline. The person with only stocks faces disaster if markets crash and they need to sell. Spreading across asset types means no single event destroys everything. Some assets rise while others fall. The overall portfolio remains more stable than any individual component, but concentration is exactly what the house payment trap creates. It forces all available resources into a single illiquid asset while preventing diversification into anything else. Breaking the trap means deliberately choosing diversification over concentration, accepting less house to enable more investment diversity, building a portfolio rather than a monument. Within investments, focus on cash flow, not just appreciation. Assets that produce income provide spending money without requiring sale. Dividend stocks pay regularly. Rental properties generate rent. Businesses distribute profits. Paper gains that exist only if you sell provide no actual benefit while you hold them. The stock that doubled is worth the same to your daily life as the stock that held flat until you convert either to cash. Cash flow from investments can eventually replace employment income. That's the goal. That's freedom. Not a large number on a statement you can't access without selling. Regular income flowing from assets you own while keeping the assets. Real estate can produce this cash flow if purchased as investment property rather than personal residence. The rental that pays you monthly is a different animal than the house that costs you monthly. Some people buy investment property before personal residence. They build cash flowing assets first, then either continue renting or buy a personal residence later. with investment income helping cover the costs. This sequence inverts conventional wisdom. Instead of house first, then investments, maybe someday, it's investments first, then house from a position of strength. Beyond diversification, making calculated risks beats both blind following and complete avoidance. Following trends without understanding them leads to buying tops and selling bottoms. Complete risk avoidance leads to guaranteed slow loss through inflation. The middle path is informed risk-taking. Understanding what you're investing in, knowing why you believe it will perform, sizing positions so that losses are tolerable. Having a thesis you can articulate rather than just copying what others do. This requires financial education. Reading, learning, following developments in areas where you invest. The more you know, the better your risk calibration. Many people avoid this education because it seems complex or boring, but the complexity is manageable if taken gradually. The boringness is preference. Many find it genuinely interesting once engaged. The alternative to education is guessing, and guessing with your financial future is expensive when you guess wrong. Modern tools make education and execution easier than ever before. Information that was available only to professionals is now accessible to anyone. Research that required expensive subscriptions is now often free. Execution that required broker phone calls now happens in apps with a few taps. AI tools can help you analyze investments, understand concepts, and process information at speeds impossible before. Digital platforms let you learn from global experts without geographic limitation. You're not competing against professionals with massive advantages anymore. The advantages have democratized. Individual investors have better tools than professional investors had a generation ago. This is an opportunity but also a danger. Easy access means easy action. Easy action without education means easy mistakes. The tools should support informed decision-making, not replace thinking entirely. Use them to accelerate learning. Use them to process information. Use them to execute efficiently. Don't use them to avoid understanding what you're actually doing. Let me bring this together because the path out of the house payment trap and toward real wealth involves multiple elements working together. First, increase income through skill monetization and value creation. Don't just accept what employment pays. Build additional streams. Second, invest rather than merely save. Money must grow faster than inflation, or you're moving backward despite feeling responsible. Third, start early and let time work. If you're young, this is your primary advantage. Use it. Fourth, surround yourself with people who are building. Your network shapes your thinking. Ambitious, growth-oriented people normalize actions that timid, fear-driven people consider impossible. Fifth, educate yourself financially. Understand where your money goes, track spending, calculate net worth. Know the basics of different investment types. Sixth, develop vision of your future self strong enough to compete with present desires. Make decisions from who you're becoming, not just who you are now. Seventh, make strategic housing choices that preserve investment capacity. Don't fall into the trap of maximum house, minimum remaining. Control this expense to enable everything else. Eighth, diversify across asset types. Don't concentrate in any single investment regardless of how safe it seems. Ninth, focus on cash flow over just appreciation. Build income streams from assets, not just theoretical gains. 10th, take calculated risks based on education rather than blind trend following or complete avoidance. 11th, use modern tools to accelerate learning and improve execution. 12th, maintain discipline over years and decades. Wealth builds slowly, then suddenly. Most people quit during the slowly phase and never see the suddenly. Each of these elements reinforces the others. Income growth provides money to invest. Investment provides growth that motivates continued discipline. Discipline maintained over time produces results that seemed impossible at the start. The house payment trap is powerful because it disrupts this entire system at the critical point. It intercepts the money before it can invest. Everything else depends on having capital to deploy. If housing consumes that capital, nothing else can happen. Escaping the trap isn't about never owning property. It's about not letting property ownership prevent everything else that builds wealth. Some people will own investment properties that generate income. Some people will own modest primary residences that leave margin for investment. Some people will rent while building portfolios that eventually let them buy in cash. Different paths work for different situations. What doesn't work is buying as much house as possible as soon as possible and spending the next 30 years paying for it while building nothing else. That's the trap. Millions of people are in it right now, working hard, making payments, feeling responsible, building almost no wealth. Understanding this trap is the first step to avoiding it. If you're already in the trap, understanding creates options, selling and downsizing, renting out rooms, refinancing to lower payments, moving to lower cost area. Each option has trade-offs, but each exists. If you're not yet in the trap, you can choose different paths. Question the conventional wisdom that leads you there. Calculate the alternatives. Make decisions based on total wealth building, not just housing achievement. Write in the comments what your housing situation is and how it affects your ability to invest. What percentage of income goes to housing? What's left for building wealth? Sometimes seeing the numbers forces confrontation with reality. Share this with someone about to buy a house without considering the trap. Someone who might make the same mistake most people make. The information might change their approach entirely, and remember this above everything. The goal is not home ownership. The goal is not following the path others followed. The goal is financial freedom. Building wealth that eventually makes work optional. Creating options that let you design your life rather than accept whatever circumstances dictate. Housing can support that goal or undermine it depending on the choices you make. Choose deliberately. Choose with full understanding of the math. Choose your future self over the immediate satisfaction of achieving conventional milestones. The trap only works on people who don't see it. Now you see it. What you do with that knowledge determines your financial future.